When I first started learning options, I came across pages and paragraphs like this. A stock option gives an investor the right but not the obligation to buy or sell a stock at an agreed upon price and date. Options are a type of financial instrument known as a derivative and their worth is based on or derived from the value of an underlying security or asset. Now, if you're like me and you naturally just don't understand these terms like that, it can be confusing. And for the first probably 6 months that I was trading options, I was still really confused. Over time, as I became more comfortable with trading options, I started to really simplify and, for lack of better words, dumb it down in my own head so that I would understand what I'm doing without trying to go back to some complex sentence. Okay, so in this video, I'm going to give you my unedited, unfiltered thoughts and how I see options now that I've been trading options for some time without the jargon that financial people are probably more accustomed to. So what is a call option? A call option is when you can buy a stock at a set price, but you have to pay for that option. So if I were to buy American Airlines, I can buy the stock at $18, but I have to pay 79 cents per share. And every contract is 100 shares, so I would have to pay $79 to buy American Airlines at $18 on December 17th. What is a put option? A put option is when you can sell a stock at a set price, but you have to pay for that option. Okay, so if I were to have 100 shares of American Airlines, but I want to be able to sell 100 shares at $17 in case it goes down below $17, then I would have to pay 56 cents per share, which there's 100 shares per contract, so it'll be $56 to have that insurance policy. What is the strike price and what is the expiration? The strike price is the price that you set to either buy or sell the stock at. So it'll be these numbers on the left, or whatever the strike price or whatever the price that you want to set to buy or sell the stock. What is the expiration date? The expiration date is simply when the option expires, or basically how long you got till your bet has to play out. Okay, what does in the money mean? Okay, in the money means that the price or the strike price that you set at is below the share price. Okay, so on Robinhood, I'll tell you the share price. Anything below that is called in the money. Okay, what does out of the money mean? Out of the money is the opposite. It means any price that you set that is above the share price. So if you take a look at American Airlines, right now it's at $17.83. Anything above that is out of the money. Okay, so what does it mean to buy a call option? I explained this a little earlier, but I'll kind of explain it to you again real quick. So buying a call option is basically when you pay a set price so they can buy the stock at a set price as well. Okay, so in this example of American Airlines, if I were to want to buy American Airlines at $17 on December 31st, then I would have to pay $1.56 per share, so $156 per contract, so that I can buy the American Airlines stock at $17. Now, why would you do that? Well, you can click on Robinhood. It shows you exactly how much the stock will have to move before you start making a profit. So if you're betting that American Airlines will go up by more than 4%, then this would be a profitable trade, right? If it goes up 4.5%, then you begin to profit. Now, if it doesn't go up by 4%, if it goes up by only 3%, then you lose your entire, you lose all your premium. Okay, so your $156. Now, what does it mean to sell a call option? Okay, so when you sell a call option, you have to have either 100 shares or the equivalent of 100 shares. So that's usually a call option. Okay, so you can buy a call option, or you would have to buy a call option so they can sell a call option. Okay, so selling call option is just basically the opposite. Okay, so you're basically saying that, okay, I have 100 shares and I'm willing to sell my 100 shares at a set price, and because I'm going to do that, I want to be paid for that option. Okay, so in this example of American Airlines, if I sell a call option at $19, if American Airlines goes up to $19, and I would have to sell my 100 shares, but I would also get paid $65 to make that trade. Okay, so now we're going to get into a little more interesting trades. These are a little more advanced, but these are really, really important in my opinion. So what is first a leap option? Like a leap option is simply when you buy a call option that expires a year or more out from today. Okay, so you're betting the stock a year between now and a year, sometime in between, the stock is going to be up by a certain amount. Okay, so if I were to buy a leap option on American Airlines, I would set the expiration date to January 2023, which is a year out. I would go ahead and buy a call option, and usually I go in the money. Okay, so it just means that it's below the share price. So if I would buy a leap option of American Airlines at a strike price of $10, then I'll be paying $858. And if you take a look at the chart, the stock would have to be up by 4% within a year for me to make a profit. Okay, so that is a leap option. When you're betting the stock will be up by a year or so or out, it's more expensive, but if you notice, it's still a lot less expensive than buying outright 100 shares. If I were to buy outright 100 shares right now of American Airlines, then I would have to pay $1,783. Now, if it doesn't go up within a year, then I lose the entire trade. Okay, so that's the trade-off. You pay up front less in cash, but if it really doesn't go up within a year, then you lose everything. Okay, so what are vertical and horizontal trades? Okay, first of all, I would say forget that financial jargon. You really don't need to know what is vertical, what is horizontal, unless you really want to, just dive deep into, terms and all that. But you only need to know, in my opinion, a couple spreads. Okay, so first, what is a put credit spread? A put credit spread is when you're betting a stock will be up by a certain time, and you get paid money up front. If the stock is up, you keep your money, and if it's down when it expires, you lose your money. Okay, so how it would look like would be if I were to set my expiration date on a put credit spread for December 31st, I would buy a put, at a strike price, and I would sell a put at a higher strike price, so that I would be collecting a credit. And this basically just means that if American Airlines doesn't go down by more than 3%, then I make a profit. Okay, so you're essentially betting the stock will just be up within that certain time frame. But if it goes down below 3%, then I lose everything. Okay, so that is a put credit spread. And note that on put credit spreads, you get paid your credit up front. Okay, so if it doesn't go down by more than 3%, then you collect your entire credit. But if it does go down, then you lose your entire credit. Okay, what is a bear call spread? Okay, so a bear call spread is basically when you are betting a stock will be down by a certain time, but you get paid money up front. And if the stock is down, you keep your money. If it's up, when it expires, you lose your money. So what it would look like is you would buy a call and you would sell a call. Okay, so you buy a call and you would sell a call at a lower strike price. Okay, so this basically means that, if it's down by more than 2.5% on December 31st, then it's gonna make you some money. But if it does not go down by more than 2% by the expiration date, then you lose your entire profit. And this, in my opinion, is a lot more safer than shorting stocks. Shorting stocks is very, very dangerous. So if you are bearish on a company, if you really think it's going to go down, then this is a great strategy to use, a call credit spread. Now, what about iron condors and butterflies? Essentially, you're just betting a stock will not move very much by a certain date. You can make really big money by using just little money. And how that looks like is let me just show you what a iron condor looks like first. You would simply buy, you would combine a put credit spread and a bear call spread. So you first, I like doing it from the put credit spread side of things. So I'll first open up my put credit spread. I'll sell a put and buy a put at a lower strike price. I would move up the same number of legs and I would sell a call and buy a call. Oops. I would sell a call. Oops. And buy it. Sell a call and buy a call at a higher strike price. So if the stock moves between negative, if it doesn't go down by more than 4%, if it doesn't go up by more than 3%, then you make $43. Your max loss is $7, and so you're really making good money if the stock doesn't move by too much. Okay, and then the butterfly just looks like where you buy a call, where you sell a call near the strike price. Okay, and you buy a call above the strike price and below the strike price that you're selling the call on, and you customize it to where you sell. You increase your sell call to 2. Okay, and so that basically sets the diagram to where if it goes up, if it doesn't move between negative 4% and 0.43%, you make $46 off of a max loss of $4. Okay, that's all that I'm going to cover today. I may do some videos with slightly more advanced options, but these are pretty much, in my opinion, the majority of the options that you would need to trade. If you like this content, make sure you smash that like button, subscribe, comment below if you have any questions. Until next time, guys, I'll see you then.